Hi, welcome to Bond Bytes, a daily bond market highlights from INR bonds. I'm Arjun Patsarthi. And in today's market, we saw a very sharp fall in the Sensex and Nifty, and the rupee also fell in sympathy to the fall in equities. Even as FPIs pulled out, foreign institutional investors pulled out huge amounts of money from the equity market. But surprisingly, they have actually invested in Indian government bonds. And that's largely because of the fact that in the global markets, especially in the US and the Eurozone, the government debt has become as risky as equities. The central banks there have pumped in trillions and trillions of dollars to show of money into the system to fight the COVID. And even before that, they are pumped in more trillions and trillions again in 2008 to fight the financial crisis. So this kind of money printing has led to the consequence of very high inflation. And with very high inflation and because of central banks buying government bonds, the returns on government bonds are extremely low, almost 0% in the Eurozone and even less, while in the US, the 10-year treasury yield is still at around 1.92%, having gone up from levels of below 0.5% in the last 1.5 years. So this clearly shows that investing in government bonds in global markets is that the investors automatically lose money because inflation is far higher than the returns available on government bonds, and this is classically called a negative real interest rate. And central banks have been caught really big in surprise by the very sharp rise in inflation. I don't think the central banks ever expected inflation to rise to such high levels, 4 decade highs in the US, record highs in the Eurozone, and doesn't seem to be coming down with lots of other factors playing into the inflationary trajectory. And this makes government bonds as risky in the US and the Eurozone, while in India, even though the RBI has kept interest rates lower and not fallen to what the US Federal Reserve is doing to raise rates to fight inflation, the yields are still very much closer to the inflation levels. And this leads to the fact that maybe money can be shifted from global bond market to Indian government bond markets, and the government could well use this opportunity to hit the global market for funds because of the very high levels of domestic borrowing to finance their fiscal deficit. And the bond markets here are very worried about the kind of supply that is going to hit them. So this would make a good uh, uh, different set of investors to invest in government bonds, taking out a large amount of pressure from domestic market, and this the liquidity from the domestic market can go into private sector investments that can spur economic growth. Thank you very much for listening in. Do not forget to download our Quick Invest by INR Bonds app, where you get the best bonds available for investment in such volatile markets. You can see the bonds, see the maturity returns that are available to you, and take an informed investment decision through our own proprietary risk models. And all you need to do is it takes you through a seamless investment process where you just invest in the bonds. It takes is a single day to invest. And do not forget to subscribe to our YouTube channel if you're not done so already. Quick Invest by INR Bonds is available on iOS and Android, and the download links are there in the description below, or you can search this Play Store and you'll get the download links. Thank you very much.